Okay, so good evening, everyone. Just confirm that anyone can confirm that you can hear me clearly so that I can start. Just confirm that you can hear me before I
Good evening,
proceed.
sir. We can hear you.
Okay, that's good. So good evening, everyone. You're welcome to another class on strategic business reporting with equity professionals. Today, we are going to be moving to another topic on analysis and interpretation of financial statements. This will take us 2 periods, today and Friday. We're going to use today to lay down the blocks, to lay the foundation. Then, hopefully on Friday, we'll solve past questions on this topic. So, analysis and interpretation of financial statements. Now, the first thing we need to look at really are the tools that we use for analysis and interpretation of financial statements. There are quite a number of them. The most popular one, basically the one that you are going to find in your exam, is majorly ratio analysis. Basically, this is the one you are going to find in your exam for strategic business reporting. Of course, there are other tools for for interpretation, and another of them is statement of cash flows. Statement of cash flows is another tool that is used for analyzing financial statement of an entity. And there are other ones, but basically, since we are not going to be talking about them, let me just mention one of them. Another one is trend analysis. I'm mentioning this because I might use it one way or the other. So trend analysis is just when you are comparing 2 years, the current year and the previous year. You're just looking at the movement between the figures of those periods. That's trend analysis. You're analyzing movement from one year to another year. So our main focus, the major tool that we're going to use for analysis is basically ratio analysis. So let's get to ratio analysis. And the most important thing for us is under ratio analysis for us to identify the categories of ratios that we have. What are the different ratios that we use to analyze financial statements? And the first category of ratio is profitability ratios. Then the second is liquidity ratios. Then we have efficiency ratios. We have solvency ratios. And finally, we have investors ratios. So these are primarily the 5 categories of ratios that we are going to be looking at. So let's pick the first one, which is profitability ratios. These ratios here, what do they do? So this ratio help measure the financial performance of an entity. So basically, the ratios here will help you ascertain and understand how profitable a company is. So majorly the financial performance of a company. So which ratios are commonly used here? So the ratios here are, so underneath profitability ratios, the most important profitability ratio is return on capital employed, that we can shorten as ROCE. Return on capital employed, that we can shorten as ROCE. The second one is your gross profit margin. The third one is your operating profit margin. The fourth one, we call that, find your examiner calling it net profit margin. The fifth one, I can put asset turnover here, but usually asset turnover can also conveniently be seen as an efficiency ratio. So, but we can put asset turnover, we can leave it here. Let it just be there. We can have cost of sales ratios or ratio. There is also one which is very similar to return on capital employed. But let me just give it to you so that you can see different dynamics of it, returns on equity. Then another one, which is just to expose you more, is the expense to total expense ratio. So these are the commonly used profitability ratios that we have. Now we say at your level, we expect that you should all be familiar with these ratios at your level. So the examiner is not totally concerned about you knowing the formula because they believe that you have done that before. So the focus of the examiner for you is more of the interpretation and analysis of this ratio. It is at skills level that we emphasize a lot more on the formula. But for you guys, it's not the formula for you. So if they give you a ratio, if they give you a financial statement, what the examiner will majorly move to would be analyze this financial statement. So it is now left to you to know which ratio you want to compute. Nobody will tell you the ratio you would compute. If you find them telling you the ratio you're supposed to compute, that means the question will be very pregnant with a lot more, that you will have done a lot of adjustment on the financial statement before you now come to ratio. If what they are saying is that just compute ratio, but you are still going to do a lot of analysis. So my explanation will be more focused around that. So the first one that talks about returns on capital employed. So basically this ratio measures the return that is generated by an entity from the capital invested by the owners of the entity. It's as simple as how much money have you made for the owners of the company. Just that this is usually expressed in percentage, not in not in absolute amount. It's expressed in percentage. So this ratio can be calculated as below. So we usually have profits all upon capital employed. Profit all upon capital employed times 100 over 1. So when you do this math, it gives you return on capital employed. So how do we interpret this ratio? If you compute this ratio and you're getting, let's say, 10%, you see that 10% will not really mean so much in a particular year. It will not mean so much. So when it comes to ratio, the outcome of the ratio, the result you get will be meaningful when it is compared with a base. Again, the outcome of the ratio will be meaningful when it is compared with a base. Is either you're comparing it with previous year, you're comparing it with another entity, majorly that. So it's when you do those comparisons, then you know whether the company is improving or the company is not improving. Now, somebody is asking me which profits, which is, of course, naturally the next thing I'm going to move into. Because when you say profit over capital employed, there are quite a number of profits that you would find. No, let me put it the way he has asked the question. There are quite a number of profits you'll find in your books. Let's ignore gross profit because gross profit hasn't considered all the major expenses. So we'll start from profit from operations, which we'll also call operating profits, and is sometimes called PBIT or profit from operations. We can have that. We can also have profit before tax, your PBT, and you can also have profit for the year, which is also called your profit after tax. So any of these profits can be used actually, but in selecting these profits, you must ensure you're matching it with the correct capital employed. You must ensure that you're matching it with the correct capital employed. If you're using operating profits, you need to ensure that the capital employed you use is your equity plus your long-term debts. You have to ensure that the capital employed you are using is equity plus long-term debt. If you're using PBT, you need to ensure that the capital employed you are using is basically your equity. And again, if you are using profit for the year, you need to ensure that the capital employed you are using is also your equity. Why is this relevant? So when you're using operating profit or PBIT and you are not using equity plus long-term debt, it becomes very wrong because this operating profit is a profit before paying interest. And remember, you pay interest to your debt holders. So therefore, this profit belongs to equity and the debt holders. And the debts that you often pay these interest to are majorly long-term debts, or there are some short-term debts that could fall in at times when you have a short-term loan or bank overdraft. But basically, you would find it that is going to be long-term debt. So on no account should you therefore use just equity here. However, when you're using PBT, this is a profit that belongs majorly to equity holders alone, though you have not paid tax, but those are not, government doesn't have interest in your company. So this profit belongs to equity holders. The same thing applies to profit for the year. It belongs only to equity holders. So usually you'll find us using either this one or this. So that means that in an exam, you'll find the examiner telling you that use capital employed as equity plus debt. When you see them telling you that you should use capital employed as equity plus debt, they are waiting for you to see which profit you are going to use. If you go and use any other profit besides this, that means you're wrong. You have not matched it correctly. If the examiner tells you that capital employed is used as equity plus debt, that means the profit you have to use must be the operating profit or profit from operations or PBIT. Now, I like working with the sources of finance directly. I don't like working with the asset parts. I can easily work with that, but for you, it becomes complex at times, and it's not exam friendly for you to use that route. Because if you want to use the asset part, usually equity plus debt equals assets, right? And it's not just asset, then it's broken down into your current and non-current, Abi. So if you want to use the asset part, that means if you want to get exactly this, it will be assets, your total assets minus current liabilities. Abi? So this will still equal this. If you want to use the asset part for equity to be total assets minus total liability, the same thing comes to this. So this, which is synonymous to net asset. Total asset minus total liabilities. Total asset minus total liability gives you net asset. So that exists, right? It does exist. But I think it's just easier for you and exam friendly for you to work with the source of finance parts. Not that you can't work with the other side of the statement of financial position, since the statement of financial position actually do balance. Now, again, you expect that you should be an expert in this by now. Now, for your analysis, when you want to analyze, it's not about you telling the examiner that we'll see for this company as is this percentage. No, that's not how to analyze at your level, or to tell them go see has increased and that's good. No, you need to be able to tell us what has caused the increase. When you're analyzing, we'll see. You need to look at the context given to you in the question, because they will definitely give you a context. They will give you what is happening to the company. They could tell you whether the company is trying to expand or the company is trying to open a new segment. And when you look at the structure of their expenses, you see that they are spending a lot of money on marketing for that particular year. So you could experience or see that we'll see for that year might go down. If that happens and you are interpreting such a ratio, you need to speak to that. You need to tell them the reason to go see how they will see, we notice that they will see decline by this amount. And this is because the company is expanding and has spent so much money on marketing, which depressed the operating profit. Those are the kind of analysis you want. And you need to relate your analysis to every context given to you in the question. I mean, correctly. You need to match it very correctly. When you solve past questions, you will see exactly what I'm talking about when it comes to analysis of financial statement. Okay, Michael, I see your hand. Please go ahead with your question.
Yeah, good evening, sir, and good evening, fellow colleagues. Thank you for the lecture. So, but my question is around the alternative way that you said you use, that you just take the asset and subtract current liability. And I know that there's other components of non-current liability, including employee obligations, deferred tax liability, pension obligations. So if you pick the asset and subtract current liability, it will still have those components which are not part of long-term debt. So I'm just confused as to that, using that formula and still getting the same result.
Good question, Michael. So you can meet. So exactly. So those are the examples of complexity that that would usually have, right? So even with what he has mentioned, when you are working with long-term debt, don't assume that this is your total non-current liabilities, because there are certain debts that are not interest bearing, like deferred tax, like your pension obligation, as you have mentioned, like your provisions that could be long term also. Those even, yeah, majorly those. So those ones should even be excluded from your determination of this amount. Okay. Now, so just stick with this to avoid unnecessary complexity. Again, if you want to use the other way around, just don't complicate it, because again, the thing for you is not the formula. And if there are any slight difference, it's not going to be material. Use total asset minus total minus current liability. All those other ones, ignore that. Don't even bother yourself. And in most questions, you find the examiner telling you what the capital employed should be. But ultimately, that should not even be an issue for you at all. Don't consider all of those. If you use this minus current liabilities, you're perfectly okay, right? Because this analysis, you need an approximate or an estimated ratio, not a precise figure like that. But again, to avoid time wasting, because this would give you very little mark. What gives you the major mark is your proper analysis, how you analyze this ratio at the end of the day supersedes this at this level. So that you won't be wasting useful time on this, you probably want to use this formula and use the figures that you have: equity plus debt, for simplicity. Okay. And again, it's not really expected that you're supposed to compute this ratio within 1 minute, right? Because by the time they are giving you, like, you're supposed to compute like 12 ratios, and you have like for 12 marks. So how do you want to reconcile that? Yeah, so I think I've addressed that area. That should not be an issue for us. So let's stick with this. Now, the next ratio is gross profit margin. Now, what this ratio looks at simply is this ratio measures the amount of gross profits that is made on every area of sales. The amount of gross profits that is made on every area of sales. So if you're making a sales of 1,000 naira for a year, for example, and your gross profit is 100 naira. So your gross profit margin is, okay, you have made 100 naira on your total sales, but to get your gross profit margin, you need to express that in percentage. Okay. So, and that's why this ratio is computed as below. So it's usually your gross profits divided by your revenue, your sales. Of course, times 100. Now, times 100 over 1. So, how do you interpret this ratio? If you want to interpret it, so you don't just tell the examiner that this, we know that the higher this ratio, the better. And a company that is doing well on this ratio would have a very high GP margin. But what makes a good interpretation is for you to speak to why this ratio is increasing or declining. You need to speak to that within the financial statement given to you. So they'll probably give you 2 years financial statement and they will give you some context. They'll give you some details around the correction. If the context given to you, you can point out what has caused increase or decline in GP margin. What are the things, looking at this ratio, number one is your cost of sales, for example, how well you're managing your cost of sales, how well discounts you're able to get from your supplier, your purchases. So majorly your cost of sales would drive your gross profit margin. If you're able to negotiate good prices from your supplier, you have a good gross profit margin. That's one. Two is your selling price. Your selling price. If you're able to sell at a very high price, you have a good profit margin. You have a good profit margin. You're able to sell at a very high price. So, depending on the context, that's how you're going to determine how you're going to give a good analysis. So again, this ratio is able to make sense if you're interpreting for 2 years. From 1 year to another, you can see the movement in the ratio and you can relate that movement to what is happening within the company, or you're comparing a company with another company, then based on the peculiarity of the two companies, you can analyze those ratio at in the best possible way. Now, similar to that is your operating profit margin. And what this ratio measures is it measures the amount of operating profits that is made on every 1 era of sales. So again, similar to this, like I mentioned, this is looking at how much operating profit you are making on every sales. And the ratio looks similar in terms of computation. So this ratio is computed as below. Is also your operating profits all upon your what? All upon your sales. And of course, you multiply by 100 over 1. So again, we believe that the examiner just assume that you're an expert in doing this formula now because they have tested it at skills level. So they want you to give a good impression on your analysis. So how do you analyze that? So for operating profit margin, if it's increasing, that this company is doing well. Again, the only reason that will have caused that is the operating expenses of the company, either its administrative expense or its distribution expense, as it were. So these are what will have cost uh, um, an improvement in this ratio. And if it is declining as well, this is what will have caused it. So you need to look at the peculiarity of the company. You need to look at the additional information given to you on this particular entity or entities so that you can pick up how you analyze operating profit margins. So you don't just tell the examiner your analysis that this ratio has increased from year 1 to year 2, so it's good. You get zero. You haven't analyzed. You haven't interpreted. you need to tell us what is the underlying factor for the improvements. That is it. If you can get a hold of that, then you're good to go as far as analysis is concerned. Then the next one is your net profit margin. And how do you, again, very similar to other ones. So this ratio measures the amount of net profit that is made on every 1 naira of sales. And this ratio is computed is below. So what do we usually use as net profits? We usually use profit for the year or profit after tax all upon sales, multiplied by 100. So again, let me even give you an opportunity. If you're analyzing this, what will have been the underlying factor for movements in net profit margin? Who can try this? What will have caused movements in net profit margin? Let me allow you to try this. Anybody?
Good evening, sir.
Mr. Hussaini. Good evening. Oh.
Yes, sir. Thank you, sir.
Yeah. Okay, I'll meet you.
Uh, Sometimes fixed costs do affect net profits. If it is either higher or lower, it affects us. When you get contribution, your contribution sometimes, because contribution minus fixed costs give you net profit. So sometimes fixed costs determine the level of net profits.
Okay. I'll give you 0.
Good evening, sir.
Okay.
Yeah, good evening.
Yeah, I think running cost is a contributing factor, and again, dividend declared for the year.
Okay. I'll give you to another 0. Somebody already answered it in the chat box. Laura already answered it. She already stated the answer. It's actually interest. It's interest. You know that after your operating profit, the next profit um, is your profit before tax. Okay. And you only get that after deducting interest. I will revise IS1 with you. Just that all of these ratio that we are using, I'm just because the templates for presentation has changed slightly. So this thing still applies to a very large extent, but I mean, she's right. What will have caused movement in this net profit margin is majorly the interest that you're paying. The interest, because that's what's next. That's what's between operating profit and net profit. That's what's between them. Just interest. Not necessarily tax, because a tax is something that is outside of our control. There's nothing you can do about it. Right? That one is a compulsory levy. But those other ones are within your control. You can manage those other ones, right? So is interest. So why I said Mr. Hussein, so you cannot interpret it as if you're interpreting uh, a management account. Yeah, you're talking about contribution, fixed costs, and all of that. We don't classify our expense in that manner. Neither do we classify our profits in that manner. This is financial report. This is a business published account. You need to be specific about the particular expense you're talking about. And the same thing in ACO too. You're talking about running costs. No, that's too generic. You need to be very specific. You need to pinpoint because they will have given you a very specific and direct financial statement. So you need to be speaking to it. You have to speak to the information given to you in the exam. So when we solve past questions, you would relate to exactly what I'm talking about. So Laura, correct. The next one, after net profit margin, is your cost of sales ratio. I think I gave you asset turnover. I think I did asset turnover. So this is a measure of efficiency, is also a measure of profitability, like that. So usually this ratio measures the number of times an entity converts its assets into revenue, into sales. Okay, or it measures the efficiency in the utilization of an entity's assets in the generation of revenue. Okay, and it is computed as below. It's computed as, again, I hope you know the formula. Let me just give it to you because it's just very late now. Ordinarily, you're the one that should be giving me these formulas so that we can focus more on the analysis than but just so late that most of you might be tired. So I just want to go straight to the point. So asset turnover looks at sales all upon capital employed. But usually, we commonly use total assets. But you will see some question. I've seen a diet, this asset turnover, the examiner they call it turnover on capital employed. That was what the examiner called it, turnover on capital employed. So in that case, you're going to be using sales all upon your capital employed. And for your capital employed, just use debt plus equity. It makes your life easy. And if you are using this one, just use total asset, current asset plus non-current assets. The least you want to be battling with at this level is which figure to use, no, don't do that. It's a total waste. So have an approach and in the exam execute it. When it comes to ratio, is a part of the exam. You want to maximize marks. So again, how do you analyze this? See, what makes a good ratio, what makes a good analysis here is more of, you need to speak to the volume of goods sold. The volume, that's what makes a good asset turnover. Because based on ICAN 101 microeconomics, what makes an entity have huge sales is when its selling prices are low and it can make large sales like that, the lower the price, the higher the quantity demanded. So usually when you want to interpret the number of times an entity converts, is able to convert its assets into sales. You are talking about the volume. That means the entity is able to sell in large quantity. Now they are selling. Probably their marketing activities are working, or they have the largest market share in that market, or their selling price is so low. That's the context you need to give to it. In the exam, you need to just know exactly where you're going and what you're speaking to. So we have cost of sales ratio. Cost of sales ratio. And this ratio measures the amount of cost of sales incurred on every 1 naira of sales. So how much cost of sales are you incurring on every sales? So it is computed as below. Is your cost of sales all upon your what? All upon your sales. So again, this is clear. In interpreting this, is just to speak to your cost of sales. It's so clear. If your cost of sales are low, your cost of sales ratios will be low. Right? And another thing you need to be able to do is to be able to relate your cost of sales ratio to your gross profit margin, because they are so relatable. Because if you have a gross profit margin of, let's say, 10%, if you have a gross profit margin of 10%, what do you think your cost of sales ratios will be? If you have a gross profit margin of 10%, who can guess what the cost of sales ratios will be?
90%.
90%, perfectly correct. 90%. Because your cost of sales or your gross profits is sales minus cost of sales. So if gross profit is 10, automatically cost of sales would be 90, because it has to be sales minus cost of sales that gives you gross profit. So if your gross profit margin is 10%, your cost of sales ratio definitely will be talking about 90%. So, and finally, here is expense to total expense ratio. Again, this one from the name is simply a particular expense divided by total expense, depending on what the examiner is looking at. So it's a particular expense relative to the total expense. So it depends on what the examiner is looking at that will determine the direction of our analysis of this ratio. Now that's profitability ratio. The next set of ratios are liquidity ratios. And these ratios measure the availability of liquid funds in a company or by a company to cover its short-term liabilities. And the ratios here are, we have current ratio, we have quick ratio, and it's also called what? Acid test ratio. And we have hash ratio. These are the three commonly used liquidity ratio. For the current ratio, this ratio here measures the ability or the availability of short-term assets in a company to settle its short-term liabilities. So with this ratio, you can know whether a company can cover its short-term liabilities or not. And this ratio is computed as below. Everybody knows this. Current assets all upon current liabilities. And we usually say a ratio of 2 to 1 is standard or is okay. Yeah, it's not bad. If you are doing 2 to 1, it's good. That means to a large extent you have double your ratio. You have double your ratio in your books. I mean, it means that you have an asset, a short-term asset that is times 2 of your liabilities, which makes sense. Okay, so this speaks to a lot around whether a company is liquid or not. But again, this ratio has some limitations in terms of measuring liquidity, because it is not all current asset items that are actually liquid assets. And that is why we have quick ratio, which is also called acid test ratio. It is to correct the anomaly of that first one. Again, they measure the same thing. So this one also measures the ability of a company to settle its highly short-term liabilities with its highly short-term assets. And it is computed as below. So what this one does is it removes current asset items that it believes is not easily convertible to cash, which is inventory. But in reality, at your level, it could be more than just inventory. It could be other assets as well that are not easily convertible to cash. And a typical example is prepayment. A typical example is prepayment. So, and in fact, in most instances, we will remove prepayment. Just that for you guys, whether you remove it or not, it doesn't really give you any extra mark. So you just remove inventory and move on. But it's something that you need to know, that prepayment can also be removed because it's not a liquid asset. Prepayment means you paid in advance. So how is that then used to settle short-term obligation? It should be backed out. It should be backed out automatically. Okay. Then the final one is the cash ratio. And this ratio measures the availability of cash and cash equivalents to settle an entity's short-term liabilities, and it is calculated as below, as the name implies, over what? Current liabilities. Okay, so those are the liquidity ratios that are commonly used. Then we have efficiency ratios. What this ratio does, so these ratios here measures the efficiency, let me not use efficiency again, measures how well an entity manages its working capital. So that's what this ratio looks at. How well are you managing your working capital? That's what efficiency ratio looks at. And the ratios here are, we have trade receivables in days, which can also be called trade receivables turnover period, or debtors in days, or debtors collection period, can be called all those names. We also have trade payables in days, which can also be called trade payables turnover period, or trade payables payments period, or payables in days. And there is also inventory in days. So these are the three efficiency ratios that we have. The first one, which is trade receivables in days, this ratio measures the number of days it takes an entity to collect its money from its receivables, from its trade receivables. And it is computed you can remind me, how do you compute receivables in days? Is it credit sales over receivables, or receivables over credit sales?
Receivables over credit sales.
Thank
No.
you. Okay, what is it? Somebody said no. So tell us the answer.
I thought it was going to be credit sales over receivables times 365.
Okay. So it's actually what the other guy said that is correct. It's trade receivables all upon credit sales times 365 days. Okay. If you do credit sales over receivables, that is doing one ratio they call trade receivables turnover, which is not something it's not a ratio that makes so much sense. So we don't usually use it. We call it trade receivables turnover. Just like asset turnover. When you look at asset turnover, you see that it's assets that is the denominator. So if they give you anything turnover, is that thing that will be the denominator. So if it happens here that trade receivable becomes the denominator, that's receivables turnover. Right? How many times is like how many times your receivables paid before they eventually settled, which does not really corroborate to so much. So we don't really, the number of times they pay does not matter. What matters is how they settled. So, and the credit, what matters is they pay within this credit period, the number of days that we gave them. So please, this is the correct formula. And this is simple enough in the sense that everybody would agree that the lower the better. Abi? Everybody will agree to that. The lower the better. Then we have trade payables in days. And what does this look at? This ratio measures the number of days it takes an entity to settle its suppliers. So how long does it take us to settle our suppliers? Then we're looking at trade payables in days. And how do you compute it? Again, similar to that is trade payables all upon is either you're using credit purchases, but I bet you in all cases you'll be using cost of sales because where do you want to get credit purchases? They hardly, I really haven't seen a question that they give you. And don't waste your time working it out. It's a total waste of your time in the exam. It's not like they will give you an extra mark for making that effort. And this one too, credit sales. Don't go and start working for credit sales. No. Use sales as given. Don't work for anything. Use sales like that. So that's this. So for this one, let me hear your voice. Is it the higher the better or the lower the better for payables in days? How do you interpret it? If payables in days is increasing, is that good? Or is it that if it's decreasing that is good? Let me listen to your
If
opinion
it
on
is
it.
The higher
increasing,
the better.
Okay, everybody is saying the higher the better, but Michael has a different opinion. So I would like to hear your opinion. He says it's depending. It's depending on what? All right, but I think Michael is in a noisy place. But let's hear him first.
Yeah,
Let's see if we can hear him.
yes, okay. Sorry. Thank you very much for the opportunity. So it depends. It depends based on the different angles you're looking at it. generally, as an analyst, you might feel, okay, it is better because it gives the company enough room to hold cash, to undertake other aspects of the business, because it takes quite a number of time to pay their suppliers, so they have access to enough cash to do other aspects of the business. But on the flip side, it sends a red flag to investors that is probably maybe the company is having a cash flow problem, in the sense that they are not generating enough money to pay their short-term debts, short-term suppliers, or it might also be that they might lose out in key relationship with key suppliers. So if they are unable to pay at a specific time, it might dampen the relationship with their key suppliers, which can hurt supply chain. So depending on how you want to look at it, you just have to strike a balance and put it in moderation. Trade payable days should not be too high because it sends wrong signal, and it should not be too low to say you are burning out cash in your business. Thank you.
Fantastic. Michael, I will look out for you. When you qualify, you need to come and stand beside me and you need to take over for me. I want to retire. Fantastic, Michael. That's a very good analysis and a very complete one. So it's absolutely correct, really. And you see, that's the mistake you find a lot of students making in the exam. They simply interpret payables in days from the standpoint of, especially those that are doing SFM. And I'm sure that's what your SFM lecturer will have told you, that you owe the money, and use it to run your business as working capital. No, now it doesn't, even in practice, in real life, it doesn't even work that way. Even though, yes. So the only way to work that way is if the supplier gives you a credit period of 50 days and you have the money within 10 days, then you can then say, okay, instead of me paying this guy within 10 days, let me use this money for something else. Even at that, a serious businessman, if you are lucky to have turned over, to have sold those goods within 10 days, why don't you pay your supplier and collect another goods? Because I'm sure the guy will not give you another goods if you don't settle the outstanding liabilities. Why do you want to go and keep the money in fixed deposit? I mean, when it's not that you're an investment company that is into making money from interest, you are a businessman. You are selling goods and services. You're selling goods. So you want your operating cycle to be very short. So as soon as you make money, you know you are done with that transaction, say to your supplier, collect another goods. You keep turning over, you make money, not from interests like that. And additionally, is that when you pay early, when you pay your suppliers as quickly as possible, it gives the supplier a good impression about you, and the guy will even extend more trade credit to you. Will give you more, it will give you more credit that you can use as a business, and it's really improves your reputation as a business. So how do you then do this in your exam? How do you interpret this in the exam? So for your exam, if you see a trade payables in days that is increasing, okay, don't say this company is good or bad. The first thing you should go and look at is for you to look at the liquidity ratio of this company, their liquidity ratio, just for us to be sure that they don't have liquidity problems. So if their liquidity ratio is bad, if it's bad, that means they have liquidity problem. Then interpret this ratio as that this company is delaying suppliers' money because they are using the money to fund their operations because, as you can see from the liquidity ratio, they don't have liquid funds. And that is why they are delaying this. That's why they have an extended trade payables in days, which is not, of course, good. But if they have a good liquidity ratio, that their liquidity ratio is improving as well, and it happens also that their trade payables in days is extending also. In that wise, you can then interpret this ratio as that the supplier, because this company, I mean, you can interpret it as the supplier has extended, has given them additional credit. Yeah, it has given this, the supplier has extended more credit days to them, which is why they're having an extended trade payables in days because they're a liquid entity. So the only reason why the payables in days might be increasing is because the supplier actually give them an extended period because they have the money to pay. Because they have the money to pay. So that's trade payables in days. And if it is decreasing, again, it also depends. You need to relate it to their liquidity ratio as well. Because if it is decreasing, it could show that maybe the supplier is saying, please, guy, pay me early. Pay me as early as possible. And that will happen if they don't have liquidity, if they have liquidity issue. It could be that the supplier has stiffened the credit period he has given to them. They have stiffened it because they are not doing well. Like, pay me early, like that. Or it could be that if their liquidity is good, it could be that they have the money and they are settling their suppliers as fast as possible. So you need to really understand this and interpret it the right way. We spent quite a number of time on that. So inventory in days. This ratio measures the number of days it takes an entity to, let me put it very simple, to sell its inventory. How long does it take you to sell your inventory? That's inventory in days. This is computed as below. It's computed as closing inventory divided by your cost of sales multiplied by 365 days. So I've seen, if I'm going to use average inventory, stressing is a stress. When you can just pick closing inventory and move on. Why do you want to be doing opening plus closing over 2? Where is that time? And again, you will not even find opening of the previous CSF. You will not find it. You will not be confused, be wasting useful time. In the exam, use closing, and that's why I gave you closing straight. Use your closing, use your cost of sales, and move on. So, of course, the shorter the better. Now, from this efficiency ratio, a real measure of its efficiency is for you to be able to ascertain the operating cycle of a company. Okay, operating cycle. And this is also known as cash cycle. I've seen some people call it cash operating cycle. No, is it a cash cycle or operating cycle? Or trading cycle? Or working capital cycle? Which other name do you know? No. You can even call it conversion cycle, like that. plenty names. Okay. So what is an operating cycle? So this is the number of days it takes an entity to convert its inventories to cash. Or the number of days it takes an entity to complete a transaction. How long does it take you to complete a transaction cycle? How long does it take you? And it is calculated as below. So it is calculated as trade receivables in days plus inventory in days minus trade payables in days. So it's better you shorten everything. Short. Let everything be short. So your operating cycle will be very short. If your operating cycle is short, that's the highest level of efficiency in terms of working capital. Because you will not lack working capital. You will not lack working capital. Because it means that you are collecting money from your receivables early enough, you're selling early enough, you're settling. I mean, everything is just sharp. You're a sharp guy. You're doing business. Ashito, I'm with you.
So then what's the difference between this one and the inventory in days?
Okay, so this one is the number of days to sell. Selling does not mean that you have collected the money.
Oh,
Yeah.
okay.
Yeah. So by the time you then collect the money and settle your suppliers, then you have completed that transaction. You sell, you collect the money, you settle your supplier. You sell, you collect the money, you settle your supplier. So that's then how long it takes, that's duration, that's the operating cycle. So you know that when an entity has an elongated operating cycle, what's that called? When an entity has an elongated operating cycle, and this is described as what? Come tell me. When their operating cycle is too long, it's too long. That's a major problem. When a company has an operating cycle that is too long, so it's either they are not, it's taking so long to collect money from, if everything is just long, because by the time it's taking long to collect money from receivables and it's taking long to sell, right? Even if you are selling, but yeah, you can't collect your money. You know, there's no way you can pay your payables. It becomes elongated also. What situation is that? Somebody should know now. Are you telling me nobody knows overtrading? The company is overtrading. See, when you say overtrading, since you guys don't know it, so it's a situation, it's a bad situation. But let me not put it as like that. Let me describe it. It's a situation where an entity is doing too much, too quickly, with with very little resources. See, why the English is this much is because that's the only situation where you can have an elongated uh, operating cycle is when you're doing too much too quickly. Because why wouldn't you be able to collect your money from your receivables? And and this one too. The only reason you can't collect is because you have sold to the wrong people. You are just in a hurry to sell. We want to make sales. You are doing too much too quickly. And you cannot now pay these guys. That's because you have very little resources. You have used all your money on inventory. You have used all your money on inventory. Because if you have resources, even though these guys are not paying, you'll still be able to settle your payables. But because you have spent all your money. So these are the symptoms. Symptoms of overtrading. What are the symptoms of overtrading? Number one, like I mentioned, you see a sharp increase in revenue. Their revenue would go up very fast, and you'll be shocked that, what happened? It would spike. Two, you see a sharp increase in interest because they have little resources. They will resort to borrowing a lot of money, and their interest would go up as a result of that. You see also a very sharp increase in taxes because of this revenue increase, it definitely will result in paying more tax because they become profitable. They'll have to pay more tax. Again, you'll see that in that year, there will be an increase in property, plant, and equipment, PPE. Property, they'll be there because that's the only way they would have been able to fund this revenue from buying PP assets. So it would definitely go up. Also, you see that they can't even collect their receivables. Receivable balance will go up. Same thing for payables. They don't even have money to settle anybody. So trade payables will definitely be high there. Of course, they will have a negative cash position, right? In the sense that they are in an overdraft position. Resort to loan. They'll definitely resort to collecting loans like that. So basically, these are the indicators or symptoms, or you find on the account that you will say, this company is overtrading. So you need to be able to, when you see problem, how do you then resolve this? How do you resolve it? From all of this, what this company need is money. That's what they need. That's their solution. Money. So how can we get a lot of points from, because that's the only solution they need. So if you are the consultant to this company in the exam, even in real life, you are their consultants, you basically would be looking at a scenario whereby you would want to have a sit down with a lot of their stakeholders. You want to have meetings with a lot of people. And the very first is you want to these interests here. This interest first. Let me take it chronologically. This interest is you need to negotiate with the banks on loan restructuring. You want to restructure the loan. And loan restructuring does not mean you're not going to pay principal. Of course, you're going to pay your principal. Nothing can shake principal. Loan restructuring is just a scenario where they can help you extend the repayment dates. Okay, or can help you reduce the interest payable, both the amount and the rate. That's what loan restructuring can do for you. When that is sorted, you want to, let's even leave government alone for now. They'll wait. This PPE, you want to pick that less, you can sell them. You need money right now to survive. Because if you don't settle banks and these other guys, they can take over the asset self. So just sell it. Sell it for good money and settle them off. For these receivables, you need to employ somebody that will help you go after them. Okay? So you can employ, we call those kind of people factor. They are called factoring companies. A factor, employ a factor to recover the trade receivables. Or you can have a deal with him. There are some factors that by the time they look at the caliber of receivables you have, they can even give you money. They can give you 70%, 65%, or even 80% of the money and say, don't worry, we will go and recover the 100%. The 100% becomes their own anyways. So that 20% is the profit they are making from that transaction. Like that. Okay. So very importantly, injection of capital, equity capital. They can inject, try to find a way, find investors. Because if it is me, I will invest in this company now. It's a good company to invest in because they're able to pull sales. That means there's a market for their product. There's a market out there. So if they have sufficient resources, they will do very well. They will do very, very well. Yeah. I see your hand, Fashion. Please ask a question.
Sir, sorry, I did not really understand point 3, employ factor to recover the trade receivable. Is it like a type of employee or, sorry, I don't really understand.
Yeah, so there are some people, there are some companies that their work is to help recover receivables. They will go after receivables on your behalf for a fee. We call them factoring companies or a factor. So you can engage them, have a meeting with them, ask them to help you recover your receivables. So they'll go after them. They'll recover it, they'll give you your money and they will take their fee. And I said that in some instances, they can even give you the money in advance. So by the time they look at the caliber of receivables you have, okay, banks do it. A lot of banks do this, especially if people get government contract and government have not paid them. They'll just go to the bank. Bank will fund that process, right? Then when government pays them, they would they would pay back the bank plus interest. Okay, but receivables financing is called factoring. Factoring. So you can engage a factor to help you, right? Since that is confusing you, maybe I should change this to engage. Actually, is that clear?
Yes, thank you, sir.
You're welcome. Okay, I think we have overflogged this particular one. So let's go to solvency ratios. Yeah, can see your hand, Moses.
Sorry. So is it possible for you to be using a Z for this your notes? Probably we'll be using the same workbook all the time so that we having a note on just one workbook all through your lecture, please.
Okay. Are you not having it on
If
one?
it's possible. Sir?
What is wrong with this one? Is it that you're not having it? Is it
That mean no.
scattered?
Yes, no, if you are having like 20 lecture with us now, we have to be looking for this these notes like in the 20 places. But if there's there, you keep on using the same there on your every lecture, you'll be adding the workbook. I think we don't have it on just one place.
It's in one place now. Everything is in this single note. I'm sharing the same note with you, and I'm already doing class 1, class 2, class 3.
Okay.
And Excel cannot work. It's not everything is not calculation. So the next one is solvency ratios. These ratios measures the stability of a company and the exposure of an entity to financial risk. So this looks at, is this company stable? Are they exposed to financial risk? Financial risk is a serious risk. It's a very serious risk. So can anyone tell me what financial risk is? When we say financial risk, it
Is
should have,
the potential inability to pay back long-term debt or just
okay,
debt.
okay, okay. Yeah, continue now. You're not done. Actually, done.
Oh, so yes, the inability to pay back debt. So that's there's always whenever a company borrows money, there's always going to be a financial risk, regardless of the performance or cash availability of the company, because at the end of the day, they will still have to pay it back to whoever lends it to them. So whenever a company borrows money, the inability to pay back the money they borrowed is always there. So that's what I understand by financial risk.
Okay, no problem. You have spoken very, very well, and you're correct to a very large extent. So yes, there is the chance or the risk that you might be unable to settle your debts, resulting in liquidation, because the risk is that you might get liquidated. Because if you can't pay, especially if those debts are secured on your assets, they can sell those assets. You'll be out of business if you don't have those assets, because they'll be your key assets that you really need to run a business. So somebody was narrating something like that to me, that was one company I've known for a long time. I knew the guy a long time when he was working with one company. And then I was now asking, where is this I said they have closed down, that they went to borrow money. And they are in oil and gas. And the banks, they placed lane, or the loan was secured on the tank farm. Banks will secure the loan on your key assets. And unfortunately, there was change in government. They were not getting contract and all of that. Now, the bank took over the tank farm and sold it. They're out of business for that. So that's financial risk, is the risk of that liquidation risk that you might be out of business if you are unable to pay. That's one. Another side to financial risk is that even if you can pay, even if you can pay, is the risk that the interest becomes so high that you would not be able to then pay sufficient dividends to the ordinary shareholders, resulting in share sell-off. Because there are some shareholders that are dividend oriented, and if you don't communicate rightly, or they can't see the growth in your company directly on their market capitalization or on their share price, they will sell your company. They will sell, not your company, your shares. They'll sell it back to you or sell it to the open market. And by the time there is sell on your shares, it reduces your market capitalization. It reduces your selling price, your market price as an organization. It's not all company that will be like Amazon. I mean, for several decades, the guy was making losses. The guy did not pay dividend to shareholders, and they believed so much in him. They stayed with him. That was because he was out there, was communicating. Now it's $1 trillion company. If you had invested just $1,000 in those days, you would be close to a multimillionaire in dollars now because of the growth that has happened to that company. Yes, some are like that. Very few are like that. For the most part, is that when you have this so much risk and you have to be paying so much interest that you're not paying dividend to your shareholders, they will sell off. That's second financial risk. So what are the ratios? And again, so that means this ratio there therefore measures the ability of a company to continue to operate as a going concern. Okay, it therefore measures the ability of a company to continue to operate as a going concern. So how do you then, what are the ratios here? We have gearing ratio. Do you know what they also call this? Leverage ratio. We have debt to equity ratio. What do we have again? We have debt ratio in itself. We have interest cover. We have interest cover ratio. I'm sure you guys are still there. I'm still here hanging on. So let's look at gearing ratio. Let's look at gearing ratio. So this ratio measures the proportion of debt that is present in the capital structure of an entity. Okay. And this is computed as long-term debt. Let me just call it interest-bearing debt. Just so that you know that is debt capital that bears interest that we're dealing with here. All upon interest-bearing debts plus equity times 100. That's your gearing ratio. Your gearing ratio. They all measure the same thing, financial risk and all of that. Debt equity ratio is the same thing as gearing ratio, and it's just interest bearing debt all upon equity times 100. So the thing is, this one now, if you have a ratio of over 50%, you can say, this company is over geared, is highly geared. And in that case, we'll say is exposed to serious financial risk. And this one, because this one you're comparing one to one, debt to equity. So for this company to be highly geared is when the debt is now higher than equity. That's 100% and above. Then you say this company is highly geared, which is very bad. Very bad. Okay, Fashita, I can see your hand. Please ask a question.
So I thought like this debt to equity, like the answer is usually in ratio, like 2:1, 3:1. That's when we know that is when it's too much or something.
Yeah, that's not bad also, but it can be in percentage too. For us, yeah, it can also be in percentage. So it's not that it's always in 2:1, 1:1. No, you can do it in percent. In fact, in most cases, we do it in percentage like that. So, and that's why we always interpret this one as when it is over 100%, then it's JED. But again, for you guys at your level, it does not, whether you put it in ratio or in percentage, is your understanding of what we are talking about here, how you're able to interpret it. That's what matters at the end of the day, because both will give you a click, but what gives you more tick is your analysis for you to know what you're talking about. So it flies. Even debt ratio also is also still the interest-bearing debt. Some people will put it total debt all upon your assets, times 100. So see, the reality is this for you guys, right? You would only find yourself computing majorly this or this, but this is just better for you because this gearing ratio, debt to equity ratio, debt ratio is the same thing. They indicate the same thing. Their indication is the same, which is what you want to get out in a company. Any one of the three. You don't need to, because in most of the question, they won't ask you to compute this ratio, this ratio. In most of the time, they will just ask you to analyze the performance and position of a company. So nobody expects you to start calculating ratios that does the same thing. You'll not get so much mark. But what gives you most of the mark is your analysis. So if two set of ratio is doing the same thing and you're computing the two, you're wasting your very useful time. So would usually use generation. When I solve past questions, you see the way I would just be exam focused and ensure that. So why interest cover? So this one is another key one that you must always do when you're looking at how to measure position of a company. So this ratio measures the number of times an entity's profit from operation, or PBIT, which is PBIT, and settle its interest. How many times can your PBIT settle your interest? And this is computed as below. Is your PBIT, or profit from operations, all upon interest paid or payable. This one is in number of times. How many times? So a ratio like this, then you not probably be multiplying it by 100, because this is looking at number of times. It's PBIT all upon interest paid. So usually for solvency, I will just compute this and this, because interest cover tells me a lot about how profitable you are. It tells me a lot about your exposure to financial risk, because it's with interest cover I'll be able to tell whether the interest you are paying is too much or not. In fact, you will tell me whether you're highly geared or not, because by the time I see your interest cover and it's going to like 6 times over three, I know that this company is good. Even if it is over geared, it's safe because it's very profitable. So there's no way you would want to do this. The most critical ratio here. And finally is investors ratios. So basically, these are popularly used on the stock markets for companies that are listed. Okay, so you see commonly ratios like dividend per share. You see ratios like earnings per share. You see ratios like dividend yield. You see ratios like earnings yield. You see ratios like dividend cover. You see ratios like dividend payout ratio. You see ratios like price earnings yield, or price earnings, not price earnings yield, price earnings ratio, P ratio. You see ratios like retention ratio. So everybody here should know dividend per share. Okay, which is the dividend paid or payable over what? Number of ordinary shares. This is dividend per share. Then we can have also earning per share. And how do you calculate that? PAT, profit after tax, minus preference what? Dividend over what? Weighted average number of shares. After I'm done with ratio analysis. The next topic I will teach you is this EPS. That's the next one I will teach you. Then, before I go to sustainability reporting, I was not supposed to teach you sustainability reporting today. I already did my notes, but there are some things I want to put there that I have not put. I want it to be more solid than last time. Okay, so this is earnings per share, right? So this is also, all these are measures for companies on the stock markets that we use to track their performance. That's why they call it investors ratios. So earnings per share is how much earnings are you giving to each ordinary shareholders. We mentioned dividend yield.
Sorry, what are weighted average number of shares?
So is the number of shares based on the number of months or the number of days you are holding the shares. So they usually time proportion this. So which is why this is coming as a separate topic later. So you will learn this. So for EPS, we don't just use number of shares. We use the number of, you would, when you get the number of shares, you will look at how many months was that shares available for that year. So because there are some people that will come and just buy their shares during the year. So those ones, you don't expect that they will get earnings for the whole of the 12 months. Those ones, the earnings should be attributable to the number of period they are there, the number of months they are there. That's the earnings to them because their money only worked for those periods. But dividend is dividend, irrespective of when you got in as much as your shares is ranking for dividend, you get it. But when it comes to earnings, because this is just a book measure. This is not the cash flow you will get. It's not like dividend is the cash flow you will get. But earnings is just, we want to look at the book. So we look at it vis-a-vis the number of months you actually held that shares. Okay, I can see another hand. Moses.
Yes, sorry, I have a question in respect of dividend per share. You said the
Okay.
formula is dividend payable divided by ordinary share capital.
Yes.
If we pay dividend to preference share capital, is it not considered here?
Yeah, you might consider it here. Now, depending on how you have categorized that preference share capital. So usually you would use ordinary share capital, which is what you should use in most cases. So for preference shares, they are another set of share capital entirely. And in most cases, those guys, their own dividend that we pay to them is fixed. Is usually fixed. In fact, they will have written it behind their 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 shares. It will have been pre-agreed for preferential share capital. That's why they call them preferential share capital. So the return to them, to those preferential share capital, is most likely not measured as this. The dividends payable, because their own is fixed. Preferential capital, most of them, they get a fixed percentage um, of return. It's fixed, just like debt capital, which is why it's not common in this part of the world in real life. Okay, and in exam, when you want to compute dividend per share, is this formula that I'm giving to you. For preference shares, is a fixed return they get. Okay, so and in real life, you won't find most companies raising preferential capital because they have this unnecessary power. So if they want to raise debt, they'll go and collect money from the bank, or they go and raise commercial paper or something like that. It's better than having a special class of share capital, right? So, so theirs is fixed in most cases. You won't compute their dividend per share this way. The next one is dividend yield, which is dividend per share over market price. So which they do market price per share, NPS. Dividend per share, this is dividend per share over market price per share. Okay, for each share. So dividend yield is, I know that for those of you doing SFM, you know Mr. Adijo has started teaching you cost of capital. I can see it. This is like cost of capital. This is the actual return to shareholders, dividend yield. If you want this to make sense, if you have two companies, company A and B, and company A is doing 6 naira, company B is doing 2 naira, you know that immediately you judge that company A is better because it's paying 6 naira. But you are an account, you guys are professionals. Don't jump into conclusion by dividend they are paying. Go and look at their market price. Go and look at, if you want to buy this company's shares, how much? If this guy market price is 7 naira and he's paying 6 naira dividend, this other guy, his own market price is 2 naira and he's paying 2 naira dividend. Instead of investing 100 naira in A, why don't you go and invest that 100 naira in B? You get more money because you can buy plenty shares. When it gives you the 2 naira per dividend, you get the same thing applies to, because this guy B is giving you 100% return. A is giving you less than 100% return. B is better. So you don't use dividend per share as a judge of advice, as a judge of investment advice. You should be looking at dividend yield. That's a much better measure. So the next one is, let me bring in earnings yield also, because the same interpretation can be given to yield. You can do your EPS. So for market price, I'll just use NPS going forward. Market price per share. Then you have dividend cover. Okay. This number of times your profits can pay your dividend. Who can tell me formula for this, please? Anyone? Anyone? Formula for dividend cover?
PBIT over dividend payable.
Okay, that's correct, but that's stressful. The exam, especially if you are focused on this, just use EPS over DPS. Because you can easily pick your EPS that you have computed, DPS that you have computed. Okay, so yeah, you're correct. It could be your profits, your EPS, your profit after tax, not even PBIT. Not even PBIT, because it's on the basis of EPS, the profit available for dividend payment. How many times can it cover that dividend? That's dividend cover. Then we have dividend payout ratio, a portion of your earnings that is paid out as dividend. How much of your earnings are you paying out as dividend? That's the reciprocal of dividend cover. So that's DPS over EPS. That's your dividend payout ratio. Then you have price earnings. What's the formula for this? Price earnings ratio. And tell us price earnings ratio. That should be market price all upon EPS. So this is one of the simplest ratio that you will know the formula, because from the name you can get the formula. Price earnings. Price, market price, earnings, earnings. Price earnings ratio. How many ratio do you have left? Oh, just one. That means you're almost over. So what does this ratio mean? What can this ratio mean? Price earnings ratio. What can it mean? Number one. So this is the price that investors place on the earnings of an entity. The price investors place on the earnings of an entity. How investor perceives your company's earnings, which can also be interpreted as the confidence of investors or of the markets in your company's ability to grow. Because if they have confidence in your earnings, if they price your earnings very high, that means they believe you will grow. Pricing your earnings high does not mean that you have huge earnings. So in fact, it means that you have small earnings, but yet they are still buying your shares. Your market capitalization is still huge. You just, if you check, which example? Yeah, if you check a company like Tesla, for example, now, company like Tesla and a company like Toyota, just check the quantity of cars sold by Tesla and the quantity of cars sold by Toyota. You see that Toyota has sold almost times 2, times 3 of what Tesla has sold, right? But check their valuation. I'm sure Tesla is a $1 trillion company. That's why Elon Musk can be that wealthy. His companies are well valued because investors have confidence in what he's doing. Even before they start making money, they're already a unicorn, a $1 billion company. So if you check valuation of Toyota, I'm not sure they're up to $100 billion. But Tesla is a $1 trillion company. And they are not making as much sales as the quantity sold is not up to. But because of the model they're operating and all that, the market believes they will go. Just like Flutterwave, our Nigerian company here, the company is worth well over $3 billion. A lot of our traditional banks are not even worth $1 billion. And they're making so much money, but the perception is about perception, it's about PE ratio. So again, when they are teaching you business valuation, one of the ways of valuing a company is PE ratio. It's used to get the value of a company, the PE ratio of a company. So it's a very important ratio that we look at, that we look out for, because it's when you see a company having a high PE ratio, buy the shares of such a company, because the perception is there that they will do very well. So we have retention ratio. See the way I'm interpreting it for you. That's the way I'm teaching you exactly how you should be thinking. You cannot be cramming this thing at your level. You need to be fluid. You need to be very fluid and explain to the examiner the way it should be. Retention ratio is EPS minus DPS divided by EPS. So this majorly looks at the proportion of your earnings that is not paid as dividend or that is retained. That's why they call it retention ratios. Okay, so I'm going to stop here for tonight. In the next class, we'll be solving past questions, which is on Friday. So hopefully we can solve as many questions as we can. They hopefully does. So I'll check if last diet question is on this. If it's not out there, I'll do May 2025, November 2024, like that. But for you guys, you're supposed to solve as far back as possible. Just solve your past questions. You're good. Just solve your past questions for this. Okay, Fashion, I see your hand, Ayobami. Let's start with Fashion. Ask your questions, please.
Okay, sir. I wanted to ask because at that price earnings ratio can also at what point can it like indicate overrating or a company being overrated? Because my investors might want to use that opportunity to short the value of a company and make money that way. So that's what I wanted to know.
Yes, you're making sense to a very large extent because P/E ratio is driven majorly by market sentiments to a very large extent. So you are an accountant, you then look at their fundamentals. And when I say looking at their fundamentals, you would look at number one, you look at their management of fixed costs. For example, you can look at, because when you look at a company that their fixed cost is very low relative to their revenue, okay, we call that operating leverage. So it shows that this company would scale. So a company that will scale, you will know. A company like Flutterwave, the example I gave you now, you will see that compared to traditional banks, they have huge fixed costs, paying a lot of rent all over the country, buying buildings, doing ATM, doing this. They have huge investments in fixed costs. Compared to their revenue, the operating leverage will be very low. Company like Flutterwave, they don't even have, maybe they have one office in VI, but the transaction they are processing, or a company like OPay, almost everybody now uses OPay. Even me, I need to go and open OPay. Everybody, and it's fast. How many offices do you see them having? How many branches? If you know the number of customers they have. So beyond the market sentiments, overrating will be determined by looking at the fundamentals, by looking at their revenue relative to fixed costs. They are looking at how heavily invested are they. That's a major indicator. And historical growth of their revenue can also to a large extent show, right? And even though that would not tell a lot about them, because most of them might not be making so much money, they might be investing in technology and R&D and all of that. And they're putting out that information about the latest technology they are working on. They might not even be making so much money yet, but you will see that this company has potentials. So you need to do your your due diligence to see that they are not being overrated. I hope I answered your question. Okay, Ayobami.
Good evening, sir.
Yeah, good evening.
Okay, my question is not directly to the class,
Okay.
but is about how we can get the recorded video of the classes and even this one,
Okay.
That's my question.
Okay. Okay. All right. So all the videos on all the courses are up to date on YouTube. I will share the folder with you to all the courses you are taking with us. These ones will be updated tomorrow. I think, yeah, this will be updated tomorrow. Every other course is up to date. The only one that is not there is the topics, the class we're having tonight. So we're going to share it to your respective groups tomorrow.